You are tuned in to the K-State Radio Network and Agriculture Today. Welcome once more to the grain markets and the latest happening, particularly on the wheat trade. Now, Dan O'Brien is with us from his office in Colby in Northwest Kansas, grain market economist, K-State Research and Extension. The wheat trade still climbing that ladder, Dan. It's been on a bullish trek for some time now, and it's all yet about limited supplies, isn't it?
Yes, in the world overall and in the U.S. Of course, the U.S. supply demand balance sheet at just around 30% stock, well, 30 or and below percent stocks to use with last USDA WASDE report. In fact, that number at 28%, 29% now, that's down from 40% the year before and 49% year before that, 53, et cetera. So tight U.S. stocks and also tight world stocks when you look at the world isolated from China. China, again, as we've talked about a number of times, wanting to maintain for food security purposes large stocks of wheat. But when you take that out of the market and figure that they're going to isolate that, they're not going to send it out and trade. You're down to 21.1% stocks use, and that's the lowest, at least since back to the major drought, the 2012-13. So we're as tight as we've been for a good number of years in terms of what you might call tradable supplies, and the trends in the wheat contracts are as positive, as strong as well. They're quote not as, they're way stronger than we see in corn and soybeans right now. The Dees contract, again, be entering not long, that'll be entering the delivery period. We'll roll over to the March for our focus, and elevators will too. Anyway, point is that from a low of about 580 or so back in July, we jumped up by early August up to about 750. It'd come back down to 675 by early September, and since then, in I guess classic futures tortured path higher, we've now been moving at about at a rate that's been actually accelerating as you look at the actual price patterns since early October, to where now have closed at 827 and a quarter, excuse me, yesterday, had gotten up higher in the day up to about 850. So we try to follow and watch some key measures of momentum in the market, et cetera. And for the Chicago wheat contract, which has a lot more volume to it, it has a relative strength index of about 68. Well, if you're at 50, you're sideways in the market. As you go to 55, 60, 65, et cetera, you're showing a lot of momentum and upward movement in the market. Well, it's at 68. And just for comparison, the corn futures contract trading at about 54, so slightly positive. For the soybean contract, trading at about 46, slightly negative. And here you have the Chicago wheat contract, the bellwether contract for the U.S. complex, trading at 68. So strong movement. And Eric, you and I've talked about, again, why? Again, we know things are tight in terms of anticipated stocks to use, but the pace of exports for U.S. wheat so far has been okay, but really below the standards needed to meet these USDA projections, which raises a little bit of caution. We've seen this in the past where we've had lofty expectations for exports and end up and don't meet them, then eventually there's a readjustment in that balance sheet. Because we work in Kansas and because we're for U.S. wheat farmers, we hope that doesn't happen, but there is a risk it could. And really where the main issues are happening is, again, having to do with that world number and the world situation. Russia talking about increasing export taxes, more uncertainty about the recovery of Canadian hard red spring wheat production. And actually, I understand from talking with people in the wheat industry, some that we have sizable quantities coming out of Australia, but excessive rains have hurt the quality so badly that again, the food quality wheat coming out of there has tightened up quite a bit. And
Domestically as well, Dan, domestically, we're worried about dry conditions broadly in winter and spring wheat country. Is that factoring in at all?
Well, I think it is, Eric, we're I guess as confirmed winter wheat market watchers, how much does the market pay attention to how dry things are right now? It adds a tick of uncertainty. It holds prices up, but really until we get out into this, so we're supported right now, and yeah, it's hard to argue with futures closing at 827 that it's not a big factor, but if to move on higher from here, I think we have to get through the winter, break dormancy, and have that much more proof that gee whiz, we really are going to have a crop shortfall in the hard red winter wheat area. And all the time we're doing that, we'll be looking up to the weather maps to the north. By the way, they're still dry for the most part in terms of drought monitor projections, up into the hard red spring and durum wheat areas up in Canada and the US and those northern states. In the, I guess, information that we're handing out that we have available to support this projection, we look at the amount of wheat by major U.S. commodity that's in an area of drought. You still have 85-90% of the durum and spring wheat areas still in drought presently, in droutish, I guess, classified drought areas. So that has to change. And there is, I guess, if you're looking to be an optimist for price and a bear for production, there still is the projection of a La Nina hanging around, which would bring dry conditions eventually to South America. It could affect the whole complex. It's not there yet. So far we've had great planting weather, but but we're sitting in November, and there's still the rest of November, December, January, February to go to see where that can all go. So anyway, if you try to put wheat in a nutshell, we've got tremendous prices, cash prices, again, in major export areas, export locations in Kansas, Salina, Topeka, Hutchinson, all at 822, and those are the highs on the Thursday closes anyway that we'd seen last week as well. So tremendous prices, and new crop bids running 775, 799, the highest one in the Topeka area for new crop harvest in July, and the weakest of them in Colby at 781. So just stupendous prices, but again, a ways to go before we would harvest any bushels.
Also noteworthy in the markets this week and at the locations around Kansas in particular, grain sorghum cash bids are quite healthy right now.
They've come back, and that seems to be tying in with well, given the dependence of grain sorghum on exports to separate it from corn, that seems to be tied in with grain elevators pulling together packages of grain, et cetera, to move. We had a very good movement, a week of grain movement a week ago. This week, or the week ending on the 11th of November. Again, a week ago, 2 weeks ago, we had a tremendous week. Not so much last week. We'll see what they do this week again. But that's the herky-jerky nature of grain sorghum exports. And again, here in Kansas, when we look to the central Kansas area where the major elevators are and see a jump up in cash prices for grain sorghum, and in particular, you just wonder about filling trains and trying to pull together packages of grain that can move. So, and you sure see that now in Salina, in Topeka, in particular, Hutchinson to some degree, pretty strong price in Colby. And here we're saying that's 598 in Colby. Garden City's still setting at 588. Well, that's a great price too, but it is a dime lower than where Colby's at. And of course, Southeast Kansas and Columbus as a representative at 573. So still all great prices, but the export oriented areas, locations for grain sorghum have all that much stronger of a price.
And soybeans just can't seem to get any traction, Dan. And a lot of that has to do with disappointment on the export front, doesn't it?
Yes, it does. Now, we've been having some pretty decent weeks. Last week, for the week ending the 4th of November, just a stupendous week of exports, 126, I think, million bushels. This week, we're back to 86 million bushels. Sales are still sitting very good at again, we're about 11 weeks into this marketing year. It's about 21% of the way in, and you're looking at forward sales of 62% of the USDA's projection of 2.2 billion 500 million bushels. So the prospects are there, but the actual movement has I guess, according to the market, not held up to expectations. So we're 21% of the way through the marketing year, about 30% of the way shipped in terms of the USDA's projections. And I think if anything, we're waiting for China to come into the market in a big way and really move things around. And so far, there's been rumors of that different times, but not in major quantity yet. Of course, the Chinese are very capable buyers, very shrewd in terms of looking for price bargains. And the longer we hang around here at these low prices, eventually who would be surprised if some week or some string of weeks we'd see a whole bunch of movement. But so much depends on just when they come to the market aggressively and what's happening back in their own country in terms of crush and you've got electricity supply issues affecting all that too. So, but to date, factors haven't come together to drive them to come in super aggressively into the U.S. soybean market. And because of that, we see soybean futures at still great levels, historically speaking, but January at 1265. Well, again, we've seen $2 and $3 higher than that in recent history. And I think our reference point benchmarks expectations are more along the lines of what we'd seen around June 1st when we had futures up to 1475. Well, we're not there now, but these are still good prices.
It just feels, Dan, like the markets, broadly speaking, and maybe the exception is wheat to a certain extent, but the markets have plateaued. They've evened off. Do you see it that way?
That is a great question. I think that I go back to last fall, and we had grain futures, corn prices 368, 380, something like that, and soybean prices last November of a year or so ago below $10. Well, now we were surprised coming into the spring. A lot of aggressive buying, et cetera, and in a way that nobody anticipated, and we drove prices up. But that was a surprise. Mm-hmm. And so now we're on the other side of this, to where we've digested the surprises that we had last year and ran up strong this summer. And if anything, have rationed usage and the soybean market in particular have been moving downward, and really the corn market until of late moving the same way. My own thoughts are, Eric, that if we're anticipating that the markets could go higher, we tend to take it there quickly and then hold it there until we see whether what we anticipated holds true or not. So in the situation we're in now, on the backside of a rally that happened a year ago, I would tend to think we run up soon and try to see if these things that we anticipate, what we're afraid of that could happen, whether they actually come about or not. If they don't, then we tend to go sideways to lower. So my own thoughts are that we run up high and we're waiting to see if things work out. Of course, following the dictates and the dictums of our former colleague Art Barnaby, who always said, well, I sold my grain. Now the market can go up. So here, now I've made my statement, and now the market will probably respond accordingly. But I tend to think we're anticipating pretty strong markets. We've ran up, and now we're waiting to see if it works out. So that's kind of recipe for a sideways market, and that you'll have to really surprise hard to get much out of it.
Producers, keep up on Dan's latest thoughts on the markets in the notes that he posts each week. Agmanager.info is where you'll find those. A good weekend to you, Dan. Thanks for joining us once more.
Thanks, Eric. Take care.
On the grain markets, K-State Research and Extension grain market economist Dan O'Brien. You're listening to Agriculture Today.